Hello everyone, this is Yaron, the founder of Investing Properties. We recorded those slides shows again because some of you last week missed out in the webinar. Some of you have some technical issues that didn't get till the end, but we'll do it again. I had a few improvement and small slides to give you more information, so stay till the end. Look, the main effort of this content is to help you to build net asset. We call ourselves investing properties because it's very essential to invest in properties to secure a future, but we need to do it in a more sophisticated way in order to maximize our returns and compound it. Let me show you how. Buy and hope to buy and hope. No. Buy and hope strategy is no longer something that we support, and buy and know is what we want to achieve. So we're going to cover here why you need to stop listening to property marketers and property investment consultants, researchers, etc. Media effect and why they need to be careful of the mainstream media influence. Why managing risk is the first most important element in wealth building and how we implement it. How do we choose the right location for high growth investing? How we create a sophisticated level of investment strategy? We're going to show you how. Last time in the webinar, we offer some bonuses at the end. We cannot do that now, but you have the chance at the end just to drop to the company email, admin@investingproperties.com.au. And basically, we offer strategies, strategy consultation with you, just to sit down with you or to talk on the phone to understand where you are today, what you want to achieve, where is your portfolio standing, what are the risk element that your portfolio is exposed to, and then to give you some direction. The second bonus was basically to maximize your returns by improving your net asset. So those property for people that have 3 properties and above, we give you an initial assessment of your portfolio. Where it's going, if you're going to meet your financial objective in 10 years' time or 5 years' time, if you need to sell, if you need to keep, etc., and it's give you a good indication. And when you see the report and the assessment, you'll be quite astonished and amazed. But it is to improve your ROI. I'm going to give you some quality luxuries top deals just to make a point. It's not relevant to any sales or anything that happened today or in the past. This is Australia Icon. This is as you know, it's Melbourne CBD. It's a very nice building. One of the best sales. It was sold very, very fast because it's how it looks. This is the same building. Is the tallest one in the South Hemisphere. You can see the from your rooms, the clouds view, basically. This is the same building. You have a nice swimming pool that you're looking at the city. You can dive and see the glass from below. Very, very nice, efficient, not far away from your room. This is another building. They have the wave effect, actually very iconic, and top architects. And this attracts a lot of investors, a lot of buyers. Another building that have a very nice lounge area with kitchen and Wi-Fi connections. And this is basically, just to say that your 1 bedroom or 2 bedroom is not relevant if it's small or big, because you have this common area that you can use it for entertainment, invite all your friends and family. Another building in Brisbane, very nice one. It didn't build yet, but it's pretty astonishing. Five-star hotel feeling. One of the other building in Melbourne, New York style, bar, lounge at the bottom, private bar. This is the common multi-purpose room that, as you see, the bathtub, the wardrobe, and we develop watch collections. This is me on the McLaren. Dockland area, inner city of Melbourne. Brisbane City View, as you see above you, this is a Roca building. This is a very nice, I think not Roca, sorry, a Meriton building, and I've been there upstairs, and you can see all the view from here. It's stunning, and this is actually when people bring clients and investors to see the view, so it's very attractive. The lifestyle in Brisbane is actually a livable city as well. Okay, who doesn't like those spots? Basically, the reason I show you that it's to show this is the way that the market, people sell real estate like that. They want to increase your emotions level. They want to give you some aspect of your dreams and your lifestyles in the future. They talk about the unique of the property, the design, the top architect. They talk about many factors that are not relevant for investment. They increase your emotions level, basically. Another element that is free of charge. When you go to a vendor seller or an investment company, it's all the services are free, and they just find your properties and increase your build you with your dreams, and then it's easy to sell your property. It's okay to do a wealth building, but you need to understand what you're doing and not just to sell real estate. Today, people are selling real estate and not selling investment. The other point is fear of commitment. When you come to a buyer agent, like us, for example, one of our services is buyer agency. So you sit down on the table and you pay money. So there is fear of commitment, even if you pay $100. Why should I pay? You can get it free from a vendor seller, but vendor seller sell your dreams. It's a bit false information because you don't know if the building that is actually above the clouds or the building that have nice wave effect with the top architect is actually a good investment. Yes, it's nice and have your potential in the long term, but would you risk it? Would this be the way that you invest in shares or businesses? Probably not. We always pay when you buy real estate. We do it upfront with full disclosure, or you pay more later on. Basically, when you sit on with vendor seller, it's all free, and when you go to a professional, you're paying money for him. Then you'll be a customer. If you're not paying for it, you're not the customer. You're only being pursued and sold to. This is the critical point in the element. It doesn't matter if you get money or not, but you always pay for real estate. Always pay for real estate, even if it's free. This is the big common mistake, and people really engage a lot of sellers that say, look, the service is free, just work for you or be with you, and you pay for that after. Graph of Melbourne long term, 1997 to 2017. If you see that in the grey area, 148,461 and in 2017, 798. So this is actually a very good growth for houses. You wish to buy in 1997 148, and also units, by the way, and increase the value after 20 years time. But this is a bit misleading because this is based on median prices, median average growth, which is not indicate every suburb. Some suburb growing value, some suburb not. Some suburb growing oversupply, some low demand. Some suburb will make money short percentage after 20 years. Some suburb will make lots of money in the next 3-5 years. Those indication of 7.46% for houses is not right, because these some suburbs are doing in fact today 30%. and it's going to push a lot. So this actually, by the way, I'm showing you that because this is a general information that you get from every property investment company and any other data. They got the data from Residex. This is nice in general. As the general rule, when you buy a property and hold it for long term, you make money. But you don't know how you make and what did you go with that. The same graph of Sydney 1997 to 2017, same conception, 240 to $1 million. Again, the question is that what happened in Sydney? Absolutely not. You buy a place in Sydney, you get an illusion. It's not all the places will got high returns and good capital growth. In the long term, yes, but you don't want to make 20% in the next 20 years. It will be pathetic growth. This is Urbis report. Urbis report is research company, statistics company. They support developers, support vendors, and basically when a builder build a property, order this report. As you see here, Queen Wharf precinct $4 billion investment, Howard Smith's $100 million investment infrastructure. Trans Apex master plan, 10 billion. This is a U-Bat bus and rail from Wollongabba to the north side. It's very, very effective for business CBD. Also, over $134.2 billion infrastructure spending has been planned in southeast Queensland by 2031. Those actually, it's very nice, but those infrastructure might impact my investment? Probably no. Another piece of information that everybody saw that when they're selling property in Brisbane, the airport duplicated. This is a very nice piece of infrastructure. It's going to boost the economy for sure, with more than 15,000 jobs and $3.2 billion output in the southeast economy. But you don't know if this piece of infrastructure will impact my specific one bedroom in Wollongabba, or will impact my house and land in Logan, or these many reasons why not to do that. But this is what you see and you get from the major markets. This is Hamilton, very, very good suburb. I have two properties in these areas, in the bad areas, by the way, because I did a mistake in the past. But as you see here, the area that cost number 4 and 14 is close 4K to the CBD, which is actually good distance. Hamilton Ridge is 7K from the CBD, approximately, even less. But this area is flood with supply. Lots and lots of units. And this is the reason the price is going down in the last 7 years. It's going down massively. It keep going down because they didn't build all the green area. They keep building. But the media company and the property investment company still keep selling that because they get high commissions. And Urbis support the developers that are building there. Why? Because this is money. This is business. This is good area by all means. In the long term, this area will be very expensive and make money. But in the short term, it's not a good buy. You can buy in Hamilton, in the area that going on the hills, which you have the nice houses, but it will be probably very expensive. 1 million, 2 million, 5 million, 30 million houses and mansion. This is good economic factors on this area, but this area, the largest waterfront renewal, it's basically it's good for foreign investor, but it's not a good indicator to investor. Lots of foreign investors, by the way, because they have the knowledge, and then they're going with advice of many local real estate agents or overseas agencies. This is another project supporter. Figures and emotions. You see, and this is what I against. It's not about investing. It's about a product. You have a lot of flights to Brisbane. You have a nice weather. You have a good economic factors, but it's not support the development or the property that you buy. This slide is basically when you go to a property investment company. This is the major things that they put on the homepage or on the front of the office. Long-term approach. This is the first thing. When you buy property investment, of course, it's a long-term, but it's also reduce the responsibility. If you buy in a very high-risk area, like Hamilton, for example, and you don't make money in the first 5 years, you can't complain. Complain because the approach was a long-term. You make money in the 10, 15, 20 years time. What do you want? Just stay, be quiet, and be patient. This is not the right approach. I won't buy share like that. I won't buy businesses like that. I'll do it much smarter than that. Negotiation power. There is no negotiation power. It's always get to a project or vendors that actually pay you the most commissions or some commission that you see, right? You also do some research calculation based on your company, but you get what you want for your business. It's not about what you want for the client. People like public buying, again, it's most of the off-the-plan companies that say off-the-plan buying. It's, you're buying off the plan, you pay today the 10% deposit and you settle on the future, depending if house land is shorter. If it's IRAS tower, it might take 3 years. But then most of the time, the price will be the same that you buy today. So actually, you don't buy before and you don't make money. You actually lose money. But it's not right definition, because some of the property that off the plan actually good area, good location, and you need to know where to buy. But most of the companies that sell real estate and sell off the plan don't really know what they're doing, and they're selling for commission, and they're selling to attract you based on the figure and the quality and how it's look. And this is not the right investment, and those property won't make money in the future. Quality proper focus. This is a very important element. It's very important on a property in some properties, but most of the companies playing on this element by itself, which is not. It's irrelevant. If you have a quality property in a very high risk area, and you basically won't make money. Research driven. As you know, I make a lot of research myself. There is no research in Australia. This part of research is data providing about what's happening in the past and about what's going to happen in terms of structure and the planning and proposals. But there is no research to tell you, okay, I buy this property 1 and property B, property A and B. Will I make money in the future? When I make money? What will be the potential growth? Nobody know. We don't know a crystal ball, but we know the risk, and this is what's missing in the market today. Everybody supports developers and researchers. So as you see the Urbis example before, a dedicated salesperson. This is wonderful, and you need if you have a good company, you need a dedicated salesperson to go with you. But usually in most of the companies, the salesperson is the one that sell your property, and after 1 year, he call you again, he sell you another property. There is no strategy, there is no objectives, and you don't know how to meet them, and you don't know as well. Not from ignorance, something you don't know to tell you, something most of them just don't know and not educated enough, because they treat it as real estate. The best formula to making money? No. We need independent advice, basically. I'll give you some case study about the Southwest in Sydney. Western Sydney, huge investment, gems waiting in bread and butter markets. This is nice. This was in Daily Telegraph. I picked that before the webinar last week, actually 2 weeks ago. And the media is focusing today on the Southwest because the airport, because a lot of other things, and we made our own research. I'm going to tell you a few headlines of a few experts that talk about the Southwest. As you see, the picture below is the potential developments. The area is massive, a lot of opportunity, but this is good for developers and for opportunity seekers, but not for investors. Investors should aim to buy property in Western Sydney if they want to higher returns and better chance of getting loans from banks, experts claim. Another one, recommended buying in areas like Liverpool, Mandurah, St Marie and Penrith because of coming infrastructure improvement, including Baddery Creek Airport. As you understand, infrastructure are nice, but infrastructure sometimes creates a lot of new development, a lot of new building, which kill the demand and kill the price, kill the value. This is going to happen. The area is not yet being transformed. Liverpool, Mandurah, Penrith are not being yet become how you call there is no better good property, but there is better demographic and not as good as. So people with money would like to invest, would like to live. On occupiers would like to look to live in places like Kellyville and Castle Hill rather than in Mount Druitt or St Mary. It's not the same, but also the renter rise is different. Anyway, another one. If you're sticking with the area of Sydney, units in Penrith, Blacktown, Mandurah, Liverpool are the bread and butter of the market. Blacktown is true. Blacktown is part of Blacktown become a $1 million suburb, and this is actually a good suburb. The other one will be good in the future, and now it's transformed. Liverpool, Mandurah, even Penrith and St Mary been transformed, but it's taken a long time to make it happen. And we don't get in that. We don't want to test ourselves in that. Another one, analysis CoreLogic data show typical properties in some of the suburbs of the Zoug region at rental yield of close to 5%. This is not really correct because the average rent in Brisbane, in Sydney is 3.5% on a very good suburbs. So some of the cheapest suburb, but not in those area as well, won't achieve those numbers. But anyway, this is what the media said, and my advice is not to buy what the media say, not to buy what everybody say. Just do their own research, and I go with a very good risk research. I collected this property 2 weeks ago before the webinar. It's located in the sought after suburb in Emerson Park. Emerson Park, Edmondson Park is very, very nice and upcoming market. A lot of media communication around that. It's actually a nice place to live. But look, if you want to live there, it is a good idea. If to invest, probably not. It's a stunning brand new 4-bedroom double-story home in 3-5 Gallipoli Drive, 4-bedroom, 2 bathroom, 1 car, 880 to low 900,000 mark. This is what's stated by the real estate agent. Will you invest here? I don't know. As I said, if it's for you living and you live in this area, yeah, why not buy one if you have the budget. But if you want to live there, but also to make money from your investment, even if you're living in a house, you want to make equity, you want to grow, and maybe in the future to shift to another good suburb or shift to another place that you like. Especially when you have the land size is 279 square meter, which is considered as a unit product. It's not a house. A house sits on a bigger land. This is what the misinformation here. When it being sold for a house on 279 square meter, it's not a house actually. And the median price in CoreLogic is talking about this type of product. Median price of houses is another scale. So nobody tell you that. Nobody know actually. Will I invest in here? No. Key drivers. These are few. These major 4 key drivers: demographics, supply and demand, distance from major CBD, and potential development. Demographic, as I said, if you compare southeast to the northwest, this is a major difference. Demographics differences. People with income are much higher in the northwest. Massive income, but it's not massive. It's just a bit more for the household. Better schools in the northwest. People lose money from set eye, especially in the rich area, going to this north area. And this actually is not that it's bad and good. It just means that it will drive the price up. Southwest is under transformation, not yet being achieved, and a lot of demographic issues in the area. Still, not in the future, but today. Supply and demand. Massive oversupply in the southwest. Massive, and demand is very, very low, very, very weak. This actually gives us the thinking if to go there. If I have areas high supply, I'm probably not make money in the short and medium term. Short distance from the CBD. CBD it's like a ripple effect. You have throw a stone to the river, you have the bubble, the ripples. So the first, when the stone point the river, this is the CBD. And then eventually the ripple effect is not being seen. Southwest is 40 km from the CBD, and it's not being yet connected to major roads and transportation to the CBD. In the future, we have the airplane, but people won't take the private chopper and fly to the CBD if they want to drive there. So it takes a while to connect Southwest to the CBD. If you look in the Northwest, these are major infrastructure. Now they're going to build the new metro line. M2 you can get in 10 minutes to the CBD without traffic at night, and actually it's very it's more connected. Of course, if you go to the primary estate, the 5 km CBD, you get the most return, and then so on and so on. But also transportation is connected the distance to the CBD. Give you an example about Lenkov Tunnel. Lenkov Tunnel become a $1 suburb. In 2001, they invest $1.1 billion in Lenkov Tunnel. This would actually put Lenkov on the map and actually increase the value. It will take time to the southwest. Another key potential development. This is a very, very important key factor, because as you see the last picture of the empty area, it's massive areas of development and insane development over there. And as much as we have more development and more potential development for developers to come to builders, it's kill the price. It's reduced it's increased the risk. It's increased the valuation risk, and it's keep the price low, and right now it's going down, by the way, for the long term. So when you have this potential development, you get into high risk area. Insane supply. 1,135 houses in the pipeline for the next 2 years. Amazon Park. 1,794 houses in the pipeline for the next 2 years in Liverpool. 3,000 units plus in the pipeline in the entire Liverpool regional area in the southwest. This is insane what's going on here. And new definition again is all assets that have land component that's more than 400 square meter. Building a lot of townhouses, a lot of units, a lot of houses, but small land. And this is actually create oversupply, and you don't want to deal with all oversupply. This is the media and researchers and companies that provide services and sell portfolio and sell investment don't tell about that. They don't know actually about that as well, because they nourish information from Hubris, for example. AVM. Whatever the market say, the media said about the Southwest is growing value. Well, this is what the media say and the sellers say, but this is not true. If you look on the AVM model, you see actually in the last 3 months, 0.8% decrease, decline value. Last 12 months, minus 3% decline. 12 months. So actually from today, in the next year, last year, the area is declining value, but the media still promoting this area. They say this is growing area, this coming area. This is not true because because the potential development, the area will keep growing, going down in value. So this is not the place to buy. 19.4% increase in the value in the last 36 months. Very poor performance, pathetic performance, compared to the average greatest Sydney, which was 37.7%. What about that? Were Kellyville, Guildford, Maryland, and more around the north, inner west, doing very good, around 7 to 8%. Some suburbs been growing to over 100% and keep moving up. Why is that? Because the risk element is low over here rather than in the southwest. If you have $900,000, $1 million, and you want to buy a place in Emerson Park, and you want to make money, just go to Guildford. It's just this example, but Guildford is good area. We invest our money to make more money and get the best ROI. Buy and hold strategy is not the best business strategy. We don't buy property by the pictures or by some person that promises us that in the long term it will grow in value. This is not the way we invest in shares. It's not a way that we buy businesses. We want to make sure this is investment, not just a real estate. It doesn't work for good ROI if you buy an OP. Property investment is different than buying businesses and buying shares. It's the same in the conception, but it's different than in the risk. When you have some good deal, and it's high risk deal, you might have the chance to make a lot of returns because it will take you a long time to close it. If you put a low risk, you might low return like term deposit or some bonds, low risk, low returns. When we talk about property investment, about how to go about areas in Australia and actually over the world as well, you need to understand where are the low risk area. Low risk area will give you high return, massive return, and you're likely not to lose money. High risk areas, you have a lot of chance, and likely you have a chance to lose money. And this has been proven. This is tested in all Australia. Risk is about equity risk. This is a massive number. I'll show you after that. This is valuation risk, this settlement risk, there is many other cash flow risk. There is a lot of parameters, but we build investment to make money in the future. Future can be 5 years or 10 years time. In 10 years time is the most best practice because 10 years time you can make a few adjustments in your low risk return to make more money. If you make 20% in the first 12 months, for example, it's great. And this is what people say. Yeah, if you make 10, But if you make the same 20% in the first 6 months, this will be better. This is the same we say, with investment that we make over 20 years time. Most of the companies are saying, look, this area been growing 40%. It's good. You make good returns in 20 years time. 40% is sweet. But I don't think so. 40% you can achieve in 10 years time or 7 years time. It's be better. Risk return. This is the way we need to go. Look, this is another slide I just want to explain more. We compare between two properties. One property is a general property that making 2% per year, and people sell you and try to look. It's a nice property, you get a very nice return. And the other property make a solid return of 6%. So 2%, 800,000. Average capital growth is 600,000. After 3 years, capital growth of the property will be 48,000 in the red one. After 5 years, capital growth wise with 2% will be 83,000. The property value after 5 years will be 883. It's nice. After 10 years, it'll be something else. If you look on the property that actually have a 6% growth, we look at on after 3 years on 152,000, and after 5 years 270,000. So if you compare 6% to 2%, you want to be on 6%. And this is the reason I say you need to make a research based on risk. This is the only way you can make more money. Of course, 83% is actually good for some people that have just did a silly mistake in the past and do that. It's good. It's not too bad. It's better than doing nothing. This is for sure. And this is the wealth creation. Say, look, just do something. It's better to take an action rather than do nothing. So let's say with the 2% properties, but you want to be in a 6%. But look, 6% is also average. This is what's happening in Brisbane today. But if you go to Melbourne or some areas in Sydney, you can achieve 22% with a low risk equity. Then the average capital growth rate will be 272,000 per year over a lifetime. After 5 years, it will be 1.3 million. 1.3 million will be much more better than 270, and of course from 83,000. Property value will be after 5 years 2.1 million, compared to 1 million in 6% and 800,000, 883 in the 2% growth. It's very essential. So remember 270,000 after 5 years with 6%. Now we talk about rental yield versus capital growth. For example, most of the companies tell you about 5.2% yield in major area in CBD with high risk. Let's say the property get $800 per week. We take LVR 80%. We borrow from the bank 80% LVR, which means 640 loan. 5% interest, we pay 2,667 per month. Let's put the constant water, let's ignore the starter for now, 200 a month extra. We're receiving gross rent of 3,467 per month from this high yield property. All the media talk about that. Positive cash, $600 per month. Yeah. We made $707,200 per year, and $360,000, $36,000 after 5 years. This is very good cash flow property. If the property doing only 2% growth in average, then the 83 is on a different 83 growth in the last 5 years. Minus 36 will give you 47,000. So you make on this property 47,000 after 5 years. This is great property. Everybody recommend it. Everybody sell it. Now, if you go to some killer properties with a low risk, but let's talk about only 6%. Don't talk about the property that have 20% and 30%. Then we took the 270,000 that you make on capital growth in 5 years. You'll cover every loss that you made in the property in the rental yield. Let's say we took a property that is 3.5% yield that nobody want to sell. The rent will be $550 per week on $800,000 property, and we make a loss of $484 per month, loss of $5,800 per year, and loss of $29,000 after 5 years. So we lose $29,000 before tax. If you look at that this way, so maybe don't do nothing. But if you look at that on a risk wise, so you took the 270,000 that you make on capital growth and reduce the 29,000. So actually you make 2,041,000 gain. So if again you compare the 241,000 gain to this 47 gain on a very nice yield property in a very high risk area, you know what the answer is. Conclusion: to make money, we need to be a bit more sophisticated and just buy investment, not real estate. Not attract to property like that. Not attract to property like the picture. Not attract to people that support by developers. But researchers tell you, yes, it's the best property. We don't know what's the growth. Do it sophisticated. But just do a very nice report that give you those figures. Again, you buy a very nice quality property. This is for sure. We try to diversify that, for sure. But we need also a strong portfolio. We need to meet a financial objective. You can also look in Google and look for exponential and compounding growth formula. This is actually the formula. And it gives you the numbers. And you can play for that. But we help you to actually understand where the growth area, what will happen, how you will achieve. And this will be by far better than just build a portfolio with nice properties that have no even related to investment. What we do differently? Investing properties is a property investment company, but we deal with risk-return based approach. So first of all, when you come to us, we assess your situation, we assess your portfolio, we assess your strategy and your financial objective. Then you come with a strategy. After that, when you know yourself, you know your figures, your budget, your way, where you live, then we do due diligence and collaborate with a risk research company, Riskwise, that actually we asked the CEO last week. And they give independent advice. They tell you exactly what's happened. They don't tell you this is a good property or bad property or support the property. They tell you this is a low risk, medium risk, or high risk area. And of course, with many other figures that support the evidence. And if you look for the lowest on the lowest risk, you make money, and a lot of money. So we map the suburbs. We map the area in Australia and suit the suburb in each state that related to your situation. Of course, we can talk about your criteria and then adapt to your strategy, but we will tell you where to go. Then we tell you where to go about the properties, because every property have a different indicator of growth, configuration, layout, quality, positioning in the ground. Some property won't be fit to the equation because the garden is too big in the front rather than the back. You get research reports. All the process will be transparent between us. The buy process, we help you with that at the buy agency. We go to inspection, we go to auction, we negotiate with the local real estate agent. We can help you to buy off the plan as well. This is also good off the plan. It's not only better off the plan, but we just help you on the process and finding a property, and we get our commission from you. Then we continue the strategy and reviews. So the effort of this effort is to build a portfolio, to build a very nice portfolio to each one of you, but also to get you the best property, the best location that give you to meet the financial objective. Long-term personal business relationship to meet your defined financial objectives by achieving the best ROI that is available based on your numbers and goals. We have no time to miss on years of growth. We need to do it right in order to secure our future. Q&A. We have the Q&A session at the last time of the webinar. Right now, because it's a webcast, if you want to ask any question regarding the webinar, about myself, about what we do, about the risk, about all about that, send us email to admin@investingproperty.com.au and we answer whatever you want. You can actually enter to the website. You can go to the Facebook page, to a LinkedIn page. You have many ways to contact us, or to the 1-800 number on the form, or send me email personally. Regarding the offers we offered before, the offer is something that's going to change your situation. Rather than it will be like a session with me or with my other consultant, or with or a session how to improve your portfolio assets. It will be very, very essential for you to understand how to make more money, because in average, most of the people that talked before bought investing in the past, bought real estate in the past. Actually not really investments. Some of them are good, some of them not, but you need to find a way to improve that and actually take you with a very secure path to improve your future. If you by theory, I just mentioned before, when you buy a property, you try to build a worth of assets and hold it for the long term, and then you make money. But you need to know how to do that smartly and make money along the path. Otherwise, you miss the boat and you won't achieve financial objective. So with the strategy consultation and with that portfolio assessment, to those who have 3 properties and above, it's very good tools and very good a way to move forward and to give you the indication, give you the best service, I would say. Hope you enjoy, hope you a good internet connection to show this video. Take care, and I'll see you in the next webinar. Goodbye.